Interestingly, you see that M2's growth has moved from negative into positive territory, but is still very low by historical standards. Message is inflation is probably going to drop. Let's see, the CPI is on the left-hand scale here, into the 1 to 2% range. And we would not be surprised to see it go negative, as we did in 2020. And we saw in 2014 and 15, and even before that in 08, 09. So we think that will happen again, and that the Fed is going to be easing aggressively before all is said and done.
In August, U.S. job growth fell short of expectations, with employers adding 142,000 jobs, nearly 20,000 fewer than analysts had predicted. This was similar to the weaker-than-expected job growth in July, but the unemployment rate dropped from 4.3% to 4.2%, unlike in July. The underperformance has raised concerns about the impact of the Federal Reserve's interest rate hikes on the economy, as some fear that the world's largest economy might still face repercussions. While a few analysts remain optimistic that the Fed can achieve a soft landing, the broader consensus views this as a pivotal moment for the U.S. economy. The Fed's upcoming decisions at the September meeting are expected to play a decisive role in either stabilizing the stock market and economy or triggering further turmoil. With the fastest rate hikes in history in the backdrop, the Fed's actions will determine whether the economy can navigate the tightening cycle without severe consequences. Cathie Wood, founder and CEO of ARK Invest, discussed the U.S. economic outlook in her In the Know podcast, warning that the economy is already in a rolling recession. She emphasized that without aggressive interest rate cuts, starting with at least a quarter-point reduction, the U.S. risks repeating past crises, such as the dot-com bubble and the 2008 financial crash. However, Wood noted that the rise of disruptive technologies like artificial intelligence and robotics could help steer the global economy away from a meltdown and back to growth, potentially adding trillions to global GDP over the next 6 years. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
We're in election campaign season, and so there is definitely gridlock, nothing happening in Washington, except, as you see here, the federal deficit as a percent of nominal GDP is still over 5%. And this is very high if you believe that we're not in a recession. If we're in a recession, then it's more understandable. There's a lot of contra-cyclical spending during, like, food stamps and social safety net spending during a recession. But one thing we know in this campaign election season is the candidates are focused on getting this deficit down. And it's been very interesting to listen to the different ways. Some would say spending cuts. Some would say tax increases. And of course, we think the answer should be a combination of spending cuts and economic growth. The best way to get a deficit to GDP down is to grow out of it. And we think that after we get through whatever this rolling recession, however it finishes, and we think we're getting close to the end of at least recognizing that it's a recession and that we've been through a rolling recession for the past 2+ years. We think that growth will take over. And as you know, we're talking all the time about the massive growth possibilities associated with the new technologies that are evolving and are ready for prime time now. I think it's very interesting that Elon Musk has actually put up his hand and said, hey, I'll help with government efficiency. You'll notice what he did at X. He cut 75% of the labor force at X, and X has not skipped a beat. Now, its advertising hasn't picked up, but in terms of the actual performance, the technology performance of X, it's gotten only better. It's getting more TikTok-like in terms of its ability to use AI and surface the interests of different people. So if he can do that at Twitter, I don't think he'll be able to do that in the government, but I know that he will bring technology to bear on the government, and that we'll probably see anyone leaving a government job not replaced. And I think the attrition could pick up if there are more interesting jobs, or more, I should say, more productive jobs created in the private sector. And what I mean by that, in the government, there is still a lot of, pushing of paper. There's a lot of bureaucracy, and technology and agentic AI could certainly help be the solution there. So I think that's an interesting dynamic that could do wonders to solve the bloat that we're seeing in the government sector right now.
According to recent reports, U.S. consumer prices rose only slightly in August, but the increase in housing and other service costs has economists concerned about persistent underlying inflation. This dampens expectations for anything more than a 0.25% rate cut from the Federal Reserve next week. Senior economist Ben Ayers noted that while inflation appeared to stabilize, ongoing pressures in housing and services remain, likely leading the Fed to opt for a modest 25 basis points rate cut to avoid fueling further price increases. The Labor Department's report showed the consumer price index rose by 0.2% in August, matching economists' predictions and consistent with July's inflation figures. Food prices increased by 0.1%, slightly less than the 0.2% rise seen in both July and June. Year over year, the CPI increased by 2.5%, marking the smallest annual gain in over 3 years and a 0.4% decrease from July's rate. Cathie Wood, ARK Invest CEO, commented that while inflationary pressures have eased, further relief is expected when the Fed begins cutting rates next week. She is confident that inflation won't be a long-term issue, which would allow the Fed to implement another round of aggressive quantitative easing, potentially boosting prices and economic growth.
And you can see the yield curve had been flattening and then inverted, and has been doing so really since 08-09 in a trend sense. But you see what happens after an inversion and a move back above zero, so that short rates are below long rates. What does that typically portend? It usually means we're in a recession. You can see the shaded lines are a recession. You can see we had gone inverted. It doesn't show here. You can barely see. We inverted for a few months in 2019, and we didn't know about COVID, and we'll never know if the inversion was an indicator that a recession was going to take place. But we did end up in a recession. Here in 08-09, moved positive, we were moving into a recession. Here we were in the recession in the tech and telecom bust. We were in the recession during the S&L crisis. We were in the recession as Volcker was trying to starve the economy of money to squelch inflation. So we're probably in a recession, and we probably, by some metrics, we have been in a recession for some time. Rolling recession, I know I've been saying for a long time. Housing went down immediately and is actually in a depression. But we do think that's a rubber band stretching, and that's why we don't think that this recession is going to be that bad. It could actually end quite quickly if we get those interest rates down and get the cyclical sectors of the economy cranking again, with so many people waiting on the sidelines, especially for housing, new and existing homes. On this next page, I'm flipping into what I described earlier. This is non-farm versus household employment. Households in the green, non-farms in the purple. You can see that non-farm employment growth is still around 2% on a year-over-year basis, which if you look through history is kind of normal. But if you look at the household employment numbers, that growth rate on a year-over-year basis is down to 0. That is more consistent with a recession. And those numbers at turning points, the household numbers, are much more reliable than the non-farm payroll, because they just don't get revised like the non-farm payroll does. Here is that revision. And so you can see the revision. This is a once a year revision in the employment rate. And you can see how big this revision was. It was over 800,000 jobs that last year, when everybody was heralding the non-farm payroll employment numbers as strong, 250-ish per month. The actual number was in the low 100s when you get through with these revisions. So again, don't trust non-farm payroll as much as the household numbers. And then here, job openings, you can see those are coming down now quite significantly. While companies are not laying off people in great numbers right now, they are not hiring. They are not hiring according to this chart. The job openings are basically disappearing. Here is the chart on personal savings. You can see what has happened in here. The personal saving rate has gone down, and it's getting close to the record lows that we saw from 05 to 07.
Although official inflation figures are declining, many Americans still feel the strain of higher prices. According to Cathie Wood, however, the real economic challenge ahead will be deflation. She believes that advances in technology will dramatically transform production processes, driving down costs. In her view, this will lead to lower prices across the board and a surge in the value of disruptive technologies, growing from under $20 trillion today to over $220 trillion by 2030. Share your thoughts on Cathie's analysis of the U.S. economy in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.